Before we write off this global commodity super cycle completely, I'd like to show you a chart on the positioning among speculants in the market in the US dollar. The market is still, broadly speaking, long the US dollar. It made sense throughout 22. And as of now, short term, it could make sense again. But if we get a true pivot from the Fed Reserve, it's debatable by now, but if we get that true pivot towards the second half of the year, then it may make sense to bet on a weaker dollar again on a more structural basis. And that could, of course, be good news for the overall commodity complex, and in particular, energy, once we get to that point in time. If we look at the US equity market over the past month, we have energy towards the bottom of the leaderboard, alongside some of the so-called defensive sectors, so consumer staples, healthcare, etc. But you also notice that materials and industrial companies, they have performed decently well so far this year, at least relative to energy. And I think it is linked to this discrepancy between the price action in industrial metals relative to energy commodities such as natural gas and oil so far this year. Natural gas is almost halved in price just since 1st of January, while the oil price is moving nowhere relative to the latter parts of last year. And if we look at just the last week, energy is the only sector not performing at all. Otherwise, equities are up relative to just 7 to 10 days ago, but energy is not, which is a clear indicator that the Chinese reopening is not bullish for energy, for now at least. If we look across this energy complex in equity space, I found a really interesting pattern across all geographies, basically. If we look at earnings expectations for energy stocks relative to the most recent set of realized earnings, then we have a major negative spread now. So the average equity analyst now expects earnings to decline materially in the energy space. That is obviously a reflection of falling prices, natural gas prices down, oil prices down, leading to less earnings in these companies. But it's also a warning signal of what I call margin compression in this sector. If inventories start to rise more rapidly across the West, I would argue that it's an early hint that margins will also be compressed for refiners and other parts of the energy supply chain relative to the almost extreme margins that we got used to last year for refiners. So for now, the momentum is clearly building in a negative direction for the expectations around the energy sector. And it's a global story. It holds no matter whether you look at US energy equities, European energy equities, Australian energy equities. The energy sector is suffering from a drawdown in the expectations. For now, I don't really see any confirmation in price action that will alter my view on the energy sector, as I've been saying throughout January. The reason is that we actually have the first signs of growing inventories in the West as well. And that is a game changer relative to last year. We all remember how Biden actively promoted a policy of pushing more and more supply on the market from the strategic petroleum reserves. That is now a story of the past. And yet we don't see a spike in oil prices as a consequence of it. That is interesting because if you look at inventories in the US, they've actually gained momentum over the past, say, 3, 4, 5 weeks, even without the US administration doing anything actively to support it. So the private market is starting to add to inventories, which to me is a hint that the demand side is not really keeping up pace with the supply side currently. in oil space. And we've been discussing over the past months whether OPEC Plus would decide to cut supplies as a consequence of this. But I still struggle to see that as a feasible scenario. First of all, from a geopolitical perspective, Russia is now incentivized to pump as much as they can. They were not a year ago. And that is an interesting change of scenery for the OPEC Plus discussion, since Russia now clearly wants to sell more to fund the war operations in Ukraine. And the lower the price goes, the more the Russians are incentivized to keep pumping, to keep the nominal income intact. And if you look at the demand side of the Russian oil and gas supply, the two major clients left for Russia are India and China. And I would suppose that China tells Russia not to contain supply, given that China is reopening right now. So why would they accept Russia containing supply at a time where Chinese demand will probably slowly but surely increase? That is a major game changer for the OPEC outlook relative to last year, where OPEC had the upper hand against the West and against its clients. I would argue that the table has turned on the bargaining power in the energy complex as well, due to geopolitics and due to Russia now urgently needing to increase production, if possible, to fund the current war operations in Ukraine. And they are strongly incentivized to do so, given the slide that we've seen in both natural gas and oil prices recently.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.